Hi everyone, thank you for joining us for our second day of our two-day course of understanding our current tax system. My name is Mary Godis and I'm a program associate with Capitol Hill campus at the Mercatus Center at George Mason University. Today we have Dr. Sarah Nutter, who is an associate professor of accounting at the School of Management at George Mason. Prior to working at George Mason, she was an economist at the Internal Revenue Service. Her research focuses on the impact of taxes and tax systems on individuals and businesses, and you can find some of her published articles in journals such as the Journal of Economics and Accounting and the Journal of American Taxation Association. So please join me in welcoming Dr. Sarah Nutter.
I really enjoy coming down to the Hill and talking to folks like you. As you probably noticed, I was wandering around finding out where people were and what they were doing. And I welcome your sort of comments or suggestions or conversations after today as well. This is really sort of a primer on tax policy kinds of issues. So I imagine some of you know a lot, and some of you, for some, it's at first exposure. But as we go along, I'm pretty interactive. So if you have questions or comments or thoughts as we go along, I welcome those as well. And in your materials, you also have how to contact me by email. I'm actually on sabbatical this year, so that's probably the best way to contact me, at least at the moment. What we're going to talk about is sort of these four things: the economics of taxation, complications to achieving it. What do we know about this thing called tax equity, and sort of sum it all up as we go along. So, to start out, I wanted to just sort of paint a big picture and run through these slides fairly quickly to give you kind of an idea of what it's been like in the United States over the past many years. Other than the big tip up you see there back during the war years, expenditures and receipts have normally sort of bounced around 20% of GDP. For the most recent year, 2007, you can see the numbers. They are 20.2% of GDP for expenditures, 18.5% for receipts. Of course, with the events of recent days, we expect this picture to look a bit different in coming years. That's kind of been the normal trend, about 20% of GDP. If we sort of step back into the global perspective on this and compare it to our OECD sort of partners, I guess I would say, as we look at tax in comparison to GDP ratios across time, you can see that basically ours haven't changed very much. Again, it's that 20% of GDP thing that we have going on. So very little change for us over time. That's not actually true for many of our major trading partners. And if you see across this time frame, again, it's a fairly long time frame, from 1975 to 2003, which is the latest I could get this data. You can see that it actually, for some of our folks, like the Italians, it's gone way up. For Hungary, it's gone way down in terms of percentage shares of revenues for GDP, for taxes for GDP. I always ask the question, I'm an accounting professor, and so where did we get it? Where did it go? And where did we get it and where did it go? When we look at fiscal year 2005, you can see where the receipts came from. Personal income taxes, generally the PAT, 43%. The Social Security may carry all of that, 32%. 13% from corporate sources. Excise taxes contribute some, and we had to borrow to cover the deficit. So that's sort of the big picture on receipts. Where did we get it? Now, where did it go? You can see here sort of where it went. $2.7 billion. This is fiscal year 2005. Social programs. Notice that Social Security, Medicare, and Retirement, it was 32% of receipts, but 38% of disbursements, of outlays. And so when we think about the implications of that over time, of course, we're going to have to consider how to fund that long term. You also see that net interest on the debt, even in fiscal year 2005, is 9% of the outlays. So that kind of gives us the big picture, again, the context in which we're working. Everybody okay so far? How about over time? And let's just focus on the receipt slide. When we look at receipts over time, now let me sort of read these to you because I know The bluish bar is excise taxes, and then we have miscellaneous other things sort of captured at the top. This is all measured as 100%. So for 100% of the receipts, what's the percentage each contributes to the total? You can see over time, this is 1950, 39.4 billion to 2006, basically 2 billion. Okay? What's changed? Told you I was interactive. Okay, excise taxes are a much smaller contributor. Over time, we look to those to source our federal receipts as sources of federal receipts. What else do you notice? I even made it red. Okay, the Social Security Medicare, as a percentage of our total receipts, has gone up quite dramatically. What do we see in the corporate share? It's decreased, and you see the size of that. It's bumped up in 2006. And notice that the personal income is just kind of bouncing along somewhere between 40 and 50%. So about 40 to 50% comes from our sort of personal income, individual income tax as a source. Now the question is, why has all this changed? Some of it we know. We can sort of tell a Social Security story and higher contributions that are flowing in to that. What's happening on the corporate side? There's lots of competing explanations for that, and we'll explore a few of those in just a minute. The individual, as I mentioned before, just kind of bouncing along, kind of setting at that pace. Well, what's going on when we think about businesses, which is sort of one thing I wanted to talk about. When we think about businesses, I was reminded of Pac-Man, because I put this together. But when we think about businesses, you have to recognize that business activity doesn't just occur in corporate form. I think most of us know that, but when you look at the statistics, one thing you really have to bear in mind is that an awful lot of business activity occurs in flow-through entities. S corporations, which are regular old corporations that elect to be taxed like a partnership at the federal level, that's all that S means. Partnerships, LLCs, sole proprietorships, these have a very vibrant economic presence in our economy, and it's where a lot of our business activity takes place. So you sort of look at this and you say only 7% of the business activity per entity, this is number of returns, this comes out of the SOI data, so the number of returns is actually corporations. We used to tell a joke that, you know, everybody's got a Schedule C, which is a sole proprietorship running through their 1040 return, but there's lots and lots and lots of those. When we look at the $29.6 trillion of receipts in the business sector, so this is corporations, S corporations, partnerships, etc. How does it break out? Well, we see that about 2/3 of it comes from what I call C corporations. Subchapter C of the Internal Revenue Code deals with corporations. So subchapter C or C corporations, about 2/3 of the receipts come from that sector. As we'll see in a minute, we're going to have to look to see what's the character, where do these actually come from, who do they go to. And then about 1/3 of it is other. Again, it's these three basic categories: the S corps, the partnerships, the proprietorships. And of course, now you see that proprietorship share is very small, only 4% of the total receipts. That's because the proprietorships are lots and lots of little businesses. When we look at net income, it's not 50-50, but about 53% comes from the corporate side, from the C corporations, 48% from the rest. When you actually look at these numbers and you can think back to the bar that we just looked at before, you can see that the sole proprietorships are actually fairly profitable in lots of ways. If you think about the kinds of activity that would occur in that particular domain, a lot of it is consulting kinds of activity, for which there's not a lot of expenses that are attributable to that. Then S corps, partnerships, each contribute their share as well. So I guess the question is, what can we take away from this? Well, I'm going to talk about corporations first, since I have them here. What is that corporate activity? That corporate activity, if you want to take sort of a look at this picture, corporations that have 500 million or more in assets account for very few returns, but account for most of the receipts, the income, income, and the taxes in the corporate statistics. So it's really dominated by those big multinational firms, large domestic firms that are in corporate form, often publicly traded firms fall into this sort of category when you look at the corporate statistics. And in fact, these largest corporations, they account for, and I have the numbers here, 60% of the total receipts, 80% of the net income, 84% of the corporate income tax. Now the takeaway from this is when you look at those corporate statistics that we get from the IRS routinely, remember that most of that economic activity is dominated by these big players. In fact, the small players in this group, the ones that are at the slower end of this, behave economically a lot more like a flow-through company. Small businesses that choose to operate in a corporate form and stay in the C category tend to be owner-manager types. And they will draw a salary that's deductible at the corporate level and pay individual income taxes on it. No double taxation there, because that's the threat when we got a corporate form, double taxation. Company pays taxes, gives a dividend, and then the shareholder pays taxes. As a small business person, you don't want that result. You don't want to pay taxes twice. So you can take salary out, deductible at the corporate level, comes to you as personal income. You could buy the building that the company is going to work in and lease it to the corporation and get back rent. You could lend money to the business and get back interest payments and principal. Now, there's nothing wrong with this. I'm not assuming any sort of attempt to defraud or anything. This is just normal business. You're going to make sure they're fair market value interest loans. You're going to make sure they're fair market rents that are charged. And you're going to pay yourself a salary. Those are all things that are perfectly appropriate. So when we look at the lower end of the corporate statistics, keep in mind that most of that activity there is a function of people moving their business activities, I guess I would say, from pocket to pocket, from their personal pocket to their corporate pocket, in a way that takes advantage of the particular tax regime they're operating in. So they will make an adjustment at the lower end for that purpose. Okay? These large multinational corporations that dominate the corporate statistics, of course, don't have that same kind of choice in a sense of. It's not an owner-manager arrangement in the same way. Okay? But keep in mind what you're looking at. So, what gets picked up in the individual statistics? And the answer is an awful lot of business activity. If you look at the upper end of the income distribution in terms of the individual statistics, there's a lot of business activity that's flowing through there. Coming through from S Corps, coming through from C Corps, coming through from individual like salary draws, etc. In that context, coming through from sole props. So all of these things, salary and wage income, self-employment income, share of business income executed through the flow-through form. I could add to that rental income if they lease it, or interest income if they loan money to their own business. All of that's flowing into the individual statistics, which can give you a skewed perspective on what those individual statistics actually tell you, because it reflects a lot of business activity as well. So let's take a look at some of the individual statistics. I know yesterday you talked about a lot of different taxes. I'll focus more of my remarks on the individual side. And these just, again, throw up a few charts. It wouldn't matter really what year I pulled. This particular year is 2003, and this was I tried to pull from different sources in terms of people that do what's called distributional analysis, trying to give you an idea of how much taxes or income shares fall into any particular vector. In this case, they use positive AGI and tax. And what we basically see with this, when we look at the individual tax statistics, is the bottom 50% paid 3.4% of tax. The rest is paid by the top. It's concentrated. I don't think I'm probably telling you anything you haven't seen before, but it's concentrated in the upper end of the income distribution. And if you look at the bars, you can see that the top 5% pay approximately 54% of the individual income tax. That's just the facts when we look at it measured as federal AGI, positive AGI, and tax. at it another way and take a broader view, and the CBO does that, the CBO sort of looks at what's called household income. So it's not just taxable income, it's income from all kinds of other sources as well, to capture this idea of not a tax return. The first one was tax return and federal API. This one is household income, and they try to pull the household together into a unit. And when we look at these tax sort of statistics, you kind of can see a similar pattern, no matter how you measure it. Sorry, I'm knocking over your things up here. Similar pattern in taking a look at this. This is quintile, so 5 different pieces, evenly split in terms of numbers. You can see that the lowest quintile has 4% of the pre-tax income. Their individual income tax is actually negative, 2.9%, their share of the income tax. And their after-tax jumps to 4.8. Same sort of pattern happens in the second quintile. And then we move on to the higher quintiles, and you can see highest quintile has 55% of the household income. They pay 86% of the tax, and afterwards have about 51.6% of the income. Now, what conclusions can we draw from this one? It tells us sort of the same picture, painted a slightly different way than what was done with the JEC report. But what can we take away? Let me ask a question. Would we think that this particular tax regime in place is progressive? Yes, we'd say it's progressive, right? We can see that. Is it redistributive? Yeah, we would say it appears to be redistributive too, because we can look at what happens at the lower quintiles. They go from 4% to 4.8%. That's a redistributive effect, and we can see it on the top one, just looking at the top quintile. You can see it pull away there. Okay? So those are sort of what we can draw away from the individual tax numbers. If we look at the rate, this is based on the same data, so now if we look at the rates for all taxpayers, this is the rates over time, again, derived from CBO data. And this is rates, I know it's hard to read, but this is 1979, and this is 2005, the last year for which we have these statistics. What do you see? You tell me, professor, right? I'm comfortable with silence. What do you see? I see a slide, right? I see a slide in this. I'm going to see Professor fall on face. I see here a slide just going down. You sort of take a picture for the 4 lowest quintiles. There's sort of a decline. And they're kind of going down together. At least it looks like that in the picture to me. Then you see the top quintile, and it's bouncing around about 15%. Sort of bouncing around 15%, up and down and up and down and up and down. Question?
Is that that last change in all the lines where they kind of, there's like kink in all the lines? Is that the 2003 tax cuts?
Yes, it is. That's the kink. 2001.
2000,
Yeah, 2000. That is the little kink that you see here. That is the 2001 tax cuts right there. And the kink affected every quintile. So that's the picture when we look at average effective sort of tax rates by households for all households. Just for fun, I thought it might be interesting to look at it for children. So if we look at families with children and just sort those folks out against CBO, there's wonderful data in this regard. And we can kind of see what happens when we look at this case of households with children. There we see the effect even more pronounced. When we look at the lower quintiles, they start out with 5% of pre-tax household income. They have a negative 7% individual tax rate. And they have an after-tax effect of share of 6.2%. And when we go to the top quintile, just use those sort of benchmark markers, they have 48.6%. They pay 92% of the taxes. Remember, we parsed the data, it's just the households with children. And 44.8% again, after. And so what you see again here is you see this redistributive effect. You see the progressivity coming through. And when you look at the tax rates, everybody's ready for me to jump to the next one. You can see a similar tax rate pattern to what we had before when we were looking at all taxpayers, except it's more pronounced because of the effect of, what do you think the effect is? What's causing the tax rates at the lower end to go negative?
Child tax credit.
All the child tax credits of various sorts and flavors. we've had in recent years pulls that negative, as well as a few other credits that we've had. And again, you see the top sort of bouncing around 15%. But again, all the lower quintiles have that sort of compatible downward tip across time. So again, it doesn't really matter how you slice and dice the data. The sort of pattern, the picture that you see is the same. Because the question when you are trying to look at any of these statistics is how do you measure income, and then how do you measure tax? Those are the two pieces of information you want to know. How do you measure income, how do you measure tax? Once you've decided that, the data sort of falls out. And so some organizations like CBO use household income. Some folks use AGI, the Office of Tax Analysis, uses a slightly different measure, but they also show the same patterns. So given sort of where we stand today, you kind of got a big picture of where we stand today, I wanted to talk about a couple things. This issue of tax equity, what does it mean? What are the complications in assessing equity, and is it really an achievable goal? Now I'm talking about this in the context of the income tax. I'm sort of directing my remarks that way. I know yesterday took a broader view, which I think is a good perspective as well. So I'm just going to run through a few tax concepts. Any tax is a function of the base and the rate. Base could be anything. It's property tax, it's your house and land, and the rate is set. You're fortunately not like me to live in Fairfax County. You just found out your base went down, your assessment went down, but your rate went up. Funny how that works. Every tax is like that. It's got a base and a rate. When we think about the income tax, we're looking for some measure of income, but the question is, how do we measure it? Economists would suggest that perhaps we ought to use some sort of broad measure. Consumption plus net accretions to wealth is Haig's and Simon's definition of income. Or personal income plus the change in value of assets. Put in layman's terms, it's what we understand to be net wealth. So how is your net worth or your net wealth increased from the beginning of time to the end of time? Of course, the thorny issue with this suddenly is it's now all realized. You actually don't get the cash just because you happen to sit in a house that went up $20,000 in value. So the tax law tends to tip toward exchanges, realizations, as being the recognition point for when we're going to actually tax something. Marginal versus effective. Again, many of you probably know this. Marginal is just the rate on the next dollar. Effective just means some average. You take some measure of tax over some measure of base to compute a rate. The one thing that gets a bit tricky, particularly in recent years, as folks have talked about substituting a national sales tax for the income tax, is what that rate actually means. Is it inclusive or exclusive? If you think about inclusive taxes, that's our traditional income tax. If you have a $100 tax base with $30 of tax, inclusive would be a rate of 23%. The tax is included in the rate. Or alternatively, it could be exclusive, like the sales tax, or gross receipts tax. Again, just terminology. Are they trying to tell us something?
I don't know.
Okay, tax concepts. These are typical tax concepts we think about as we design a tax system. So the benefit principle, benefits received, the tax should be a function of that. The question is, how do you measure benefits received? Sometimes when we move to things like user fees and things like that for the national park system, that's an attempt to get at that particular idea of taxation. Ability to pay, those that can, should pay more. The question is, what do we base our ability on? Income, consumption, wealth, the strange thing that economists call utility. Should we use that? In the income tax law, of course, we try to measure some measure of income, but even that gets swampy real fast. Then we need to think about equity, and we usually think about equity two ways. Horizontal equity and vertical equity. This is my simplest definitions that I could come up with. Horizontal, equal, should pay equal taxes. Vertical, unequal, should pay unequal taxes. The question is, how do you measure equal? So how do you compare a single person versus a married couple to a married couple with children? How do you take into account innate differences between these various household units? Should we or should we not? Currently we do. Should we? Should we not? It's an open question, but at the moment we think it's important. Progressivity, I can tell by the question you answered, you all know what this is. When we think about progressivity, there's a lot of ways to look at that. Progressive rates, or taxes rise faster than income, if income is sort of our benchmark. Progressive, taxes raised rapidly with income. We have a 10% tax rate on income. If you have more income, you pay more taxes, but it's still at a 10% rate. Regressive, taxes rise slower than income. Folks talked about this a lot in the sales tax area, for example, of it being a regressive tax. It's indifferent to the amount of income, and generally folks at lower income distributions will pay effectively higher rates if we look at it from the income perspective. Other tax goals, efficiency. Minimize the economic cost per dollar raised. That's a hard one to get at, always. Simplicity, administrative ease. The easiest tax I could potentially put on, I could implement today. And it would be a toll tax. You can't get out of this room unless you give me 20 bucks. Right? Administrative ease and efficiency. 20 bucks to get out of the room. Tax incidence. There's a big difference between the statutory, who pays the tax, and who the tax really falls on. Not necessarily the same folks. So for example, who pays the corporate tax? If you talk to 5 economists, and by the way, I'm an accountant, I'm sort of an applied economist, you'll get at least 10 different opinions on who pays the corporate tax. But they will agree on one thing. They will agree that the corporate tax either causes wages to go down, employees' wages to go down, or it causes consumer prices to go up, or it causes returns to capital to go down. They all agree that it has one of those 3 effects. Either wages go down, prices go up, or returns to capital go down. After that point, there's a lot of disagreement and a lot of comments about it depends. Currently, CBO puts all of that incidence of corporate tax onto the capital side, the returns to capital. That's where they put it. But there's a disagreement about that. And there's a fungibility of capital that crosses borders. In other words, capital can relocate itself to another jurisdiction. Then it becomes even murkier as to how it falls on those 3 pieces and how it falls. At the end of the day, people pay taxes. If you think about what the economists are arguing about, they're arguing about returns to capital, to go to people, to owners. They're talking about a decline in the wage rate, to go to workers. They're talking about an increase in prices that affect consumers. At the end of the day, no matter how they slice and dice it, the corporate tax falls on people. The question is, which people does it fall on? Social Security tax. When we think about the Social Security tax, there's a similar conundrum, and I actually just read a research study that is quite convincing, actually, by a fellow down at Georgia Tech, who's done sort of a complicated econometric, it's called the difference in difference model, to look at where does the Social Security tax fall. And he's really come to the conclusion, based at looking at a period of time, a long longitudinal period of time, that the Social Security tax falls on the worker. And that's where it lands. So again, even though we technically split it between the employer and the employee, economically, the impact is on the worker. It falls on the worker. People pay taxes, no matter what entity we might be actually delivering the tax to the government. I wanted to talk about some complicating factors. And this is the behavioral responses, and I know yesterday you talked quite a bit about these, so I'm not going to spend as much time on these. But these are the ones that I think about. Behaviorally, over time, defer, 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 defer. Or alternatively, accelerate, accelerate, accelerate. If you see a important tax benefit coming to you that might expire. We certainly hope, given what's just happened here on the Hill, that more people are going to buy houses, right? put a nice big tax credit out there and you hope people that's going to induce buying. It was purposely put in there with that idea. But it's got a end zone. It's got a timing effect. So, defer, over time, or accelerate. Between entities, I already told you the story of the small business owner who has a corporation and he's the owner-manager. He will shift, or she will shift, income between those two entities, these two different pockets that they have, in a way that is tax advantaged. And again, I'm not suggesting that these are illegal or improper things that they're doing. They're all going to do it above board, just the way it ought to be, as if it were a, an arm's length transaction. But they will react, and they'll shift from entity to entity, between partnership and corporation. You have more making an S election than ever before. If you really look at the corporate statistics, there's not much there yet, left anymore. There's not much there. The only thing that's left is the large 500 million or more publicly traded entities. All the rest of the business activity, to a large extent, has been moved right out of that and is going forward. Between jurisdictions, you see this particularly with the large multinationals. They will exploit the differences in tax regimes across the world. Just like the small entrepreneur does, who has a corporation and a owner-manager relationship to it. Not anything dishonest about it, but they will use the differences across tax regimes to their advantage. Again, I'm not talking about fraud, I'm just talking about tax planning. And between types. And I have sort of a laundry list here: ordinary to capital gains, active to passive, U.S. versus foreign source, which can be important for our big multinational firms. And then all the things you talked about a bit yesterday too. Whether you work for pay or not. Whether you spend or save, whether you buy or rent. Everything that tax policy touches on affects the way that you and I behave every day. And if you know what affects us, it's going to affect businesses. It's going to affect owner-managers. It's going to affect larger companies. Because companies are nothing more than a group of individuals gathered together, hopefully for a common purpose. I always say hopefully for a common purpose. But that's what we hope. Now, economists give a couple of these special names. The income effect and the substitution effect. The income effect is basically raise my taxes and I'm just going to run faster to stay in the same place. I'm going to work harder and longer. That's the income effect. The substitution effect says, well, you increase the tax rate, I'm going to make a trade-off. I'm going to do something different than run faster and jump higher. These two effects are competing, and they apply sometimes to different sorts of folks depending on where they sit in this whole plethora of tax incentives that we have. But the funniest example I saw was this one. Not the Rolling Stones. They canceled plans for British concerts, citing high tax rates. Mick Jagger said, I was tempted to bite the bullet, but there were over 200 people involved. Is that an income effect or a substitution effect? A substitution effect. That's what it is. They're substituting. They're not going to run harder and faster to stay in the same place. They're going to sit down and put their feet up and pop open a soda. The reporter notes, one knows a rock band is getting old when it cancels a tour for tax purposes. Another big complication when we think about tax policy in general is complexity. So I know you might not all be able to see this and all read it. The good news is that under the new tax plan, you get a $2,312.70 refund. The bad news is that it was so complicated, you owe me $2,310. Nina Olson, the National Taxpayer Advocate, lists complexity as the #1 problem facing U.S. taxpayers. This is in the 2008 report to Congress, and she notes that her estimate is that 14% of all income tax collected, in other words, $193 billion, is spent by Americans trying to comply with the tax law. That's a lot. Tax code changes have averaged 1 per day over the last 8 years. 500 changes in 2008 alone. It's staggering when you think about the complexity of the existing tax code. And by the way, I don't have a slide on it either. I used to have a slide that talked about, if you think about it, I was predicting that we would actually have tax reform, just because it seems like we do. 1954, 1969, 1986. If you look at periods of time, it's about 15, 20 years in between, and suddenly everybody goes, we gotta do something, okay? We haven't done that yet, and it's just getting more and more complex. Another complicating factor is this idea of tax expenditures. Now, there's a lot of controversy about tax expenditures and how we measure them and what they are, but I think you simply can think about them as tax reductions due to exclusions, deductions, exemptions, and credits. We say we're going to tax you on income, that's your base. We're going to apply a tax rate to it, but then you say, but not that, but not that, but not that, but not that, but not that. And you pull things out. So things that we've pulled out: pension contributions of all forms, employer contributions for medical insurance and care, mortgage interest on owner-occupied homes. These are the big ones. Non-business state and local taxes, capital gains, accelerated depreciation. We could go on and on and on and on. You have to recognize, of course, that tax policy is an instrument of social policy in many instances. So things that might not get done in other fashions get done through the tax code. That's why we have all those negative numbers when we look at tax rates for the lower income quintiles. We could carry that out through direct government programs as well. Be another way to do it. If we look at the tax expenditure budget, now I know this is tiny. I've worked for quite a while trying to make it bigger and couldn't. This is sort of categorized based upon the nature of it. So about 40% is commerce and housing. That's the mortgage, interest deduction, etc. Health, that's the provision for medical insurance and all of that, allowing that to be tax exempt. 16.7%. Education and trading, 12%. Those are the big ones, really, of what the tax expenditure, what they call it a budget now. But when they're measuring these, we're going to take everything of income and then pull all these pieces out. This is the focus of most of those exclusions, exemptions, deductions, or credits. Now, again, I said you could get this done another way. And I call it my green tea example when you don't have this. Okay? But let's just say we want to create a policy. We have learned that green tea is beneficial to health. And as a public health policy, we really want to get people to drink more green tea. Basically, through the government, there's, I think, of 3 ways to get it done. Regulate it, legislate it, and you make a rule that says all businesses with more than 10 employees must provide green tea. Bang, done. Okay? Or you could make a direct expenditure, an outlay, a government program to provide green tea to all businesses and homes. Right? You could buy the green tea and you could ship it off, or you could provide a voucher that they could take to their store to get green tea. You could do it through direct government expenditure. Or you could do a tax incentive. We'll have the green tea tax credit. I'm an advocate of this, write this down. Okay? GTTC. Okay? Because we'd like to encourage, we'd like to incent, we'd like to have more green tea drunk. All because we believe green tea is beneficial to health. So when you think about policy, tax policy has been used an awful lot to accomplish social policy of some sort. The complexity that we just talked about, most of that complexity can be related to the of trying to accomplish something through the tax system. But we could have accomplished other ways if we wanted to. And it might have been more difficult, but we could have accomplished it. So to give you an example of this, the Tax Policy Center over at Brookings actually sort of took a look at these tax expenditures and said, okay, what if we didn't run them as tax expenditures? What if instead we just did a direct government outlay? What would it be? So this is for 2004, and so for this pension contributions and earnings, the revenue loss, this would be in millions, billions of dollars, $152 $1.2 billion of revenue loss, the tax expenditure, we could literally just cut people a check for $180,000 or $180 billion instead. That'd sort of be the equivalent revenue outlay that we could make. So keep in mind that there's more ways to get sausage made, to get green tree consumption, up than through the tax code. Of course, I'm an accountant. That's my background. I prefer that you make this tax code as complicated as possible. I'm currently educating the next generation of accountants, and they're going to need jobs. So make sure it stays complicated for me. Okay? Implications of complexity. And again, I don't know if you read all this, and I guess this is my call to full employment for accountants. It's confusing and complicated. Layers of new tax cuts, credits, rates, exemptions. Taxpayers will call it a nightmare when they try to decipher it. I call it job security. Be careful what you build. The alt-min tax has been sort of a thorn in our side for a really long time. I just captured some headlines, and you can kind of see this across time. Alt-min tax will be the next target. That's 2004. 2006, it's moved to coping with the alt-min tax. And then finally, 2007, the IRS.gov online alternative, minimum tax assistance. Actually, the IRS responded and put it online. It's becoming a problem for more and more U.S. citizens. It's concentrated. If you've got, it's kind of a peculiar tax regime. If you've got kids and you live in a high-tax state, you are the ones that are going to get taxed first under the alt-min tax. You just start to lose your personal exemptions. They take away the state deductions for taxes. And so folks that have those two tax characteristics will end up being hit with the alt-man first. Now, perhaps that makes sense to you from a policy perspective. I'm confused, but maybe it makes sense to you. Okay? This is what's going to happen over time. And again, this changes day to day. A new patch was just put in, so it changes this picture just a little bit. But it's only patches. Patch, 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 patch. As soon as the patch falls off, the alt-min tax is going to swamp the current tax system as we know it. And you can kind of see some of the numbers here that the Tax Policy Center projects. Now, why did this turn out to be a problem? The alt-min tax, when it was put in the after effects of discovering that 155 tax-paying units, 155 taxpayers, back in 1969, didn't pay any income tax. Congress said, we're going to fix that. That's not fair that high-income taxpayers didn't pay any tax. So they put the alt-min system in. Now, what they neglected to do, of course, as we all know, they didn't even rig it for inflation. If they would have rigged it for inflation, we wouldn't be having the conversation we're having today about the alt-min tax and how we're going to replace the revenue source. So it was never indexed for inflation at all. These are the states. This is from the Tax Foundation. There is new data available from another year, but it wouldn't change much. The top 10 states that get hit by it are in blue, primarily located in New England. Many of you may work in these, or congressional members in these offices. Ohio, Minnesota, California, Oregon. All places that have high state taxes, all places that if you have kids, you get whammed at even lower and lower numbers. Okay. These numbers, percentage-wise, that are shown here have all gone up. You could tip them up just about 1% in each one of the categories. For example, New Jersey tops the list, I think now at 6.8%, almost 7% of all returns filed in New Jersey are going to have to pay alt-min tax, did pay alt-min tax in 2005. It's even higher than that now. So it's going to keep coming back at us, and patches are going to last forever. Personal exemption is really the same problem. Back in the olden days, when the income tax was put in, the thought is that an average family with kids, parents, that had sort of an average income wouldn't be subject to the income tax. Again, it's the same problem because that personal exemption was put in to provide enough for a family to live on. That's why you have the personal exemption built into the income tax. In today's dollars, and I'm sorry this is so small, went small, it's $3,300. I don't know, maybe it's a little higher than that now, because they're starting to do some mild indexing. Probably somebody here, what is it this year? Does anybody know? Well, let me tell you, I have 3 kids. There is no way I'm raising them on $3,300 a year. It's not happening. That's barely the shoe budget, right? Okay? And one soccer team, event. If we actually indexed it, if we indexed it to inflation, it would be about $5,000. If we actually indexed it to income per capita, it'd be $15,000. Again, be careful what you build. In both instances, these weren't indexed for inflation. And this is in the great circle of life. In the great circle of life, if we're fortunate, someday we'll die. And we might be subject to estate tax. Okay? If we're subject to estate tax, again, you kind of run into the same problem. As I sort of ran the numbers that I wrote them down just before I came here, if we would have indexed the exemption around the estate tax, you could have an estate of about $15 million today and not be subject to tax. The failure to index for inflation, again, sort of bites us in the back because nominal dollars and real dollars aren't the same thing. So again, all the controversy about the estate tax, I don't think we'd be having the conversations that we've had over the past 10 years about the estate tax if we would have indexed the exemption amount. And it just keeps getting bigger. The tax code now is an unwieldy sort of thing to deal with. Again, as an accountant, I'm happy, keep on putting in those strange little rules. But it becomes very difficult when Nina Olson a few years ago said, could we please just have a consistent definition of child in the Internal Revenue Code? Imagine how a family might try to figure that out. And what benefits they might take advantage of or miss because it's just too complicated to figure out. So the solution, simplify. Simplify the tax system and eliminate all the deductions except one. Which one? Mine. Simplifying is not an easy task for everyone to take on. And how? I don't want to pay my fair share of taxes. I want to pay someone else's fair share. This idea of fairness and equity is hard. It's hard to figure out what an equitable tax system would look like. How we satisfy horizontal hurdle for equity. How we build in, if we think it's appropriate, an ability to pay. People that have more should pay more. How we build that all in a way that is simple and not complicated. And the danger with all this, and I'll just point out 2 unintended consequences. People react to incentives. They will behave differently. Back sort of in the post-86, I guess I'm dating myself, in the post-86 Tax Reform Act, I was at the IRS. And at that time, I did some work looking at these small corporations that didn't move, that didn't change the status. And as you might remember back in 86, the rates flipped, went the other way around. You wanted to get money into your personal pocket because the rate was lower than it was in the corporate pocket, and before the 86 Act, it was reversed. So we did see, sort of did a study looking at this, we did see that these owner-managers, they simply shifted their income straight out of the corporate shell and straight into their personal pockets. And they did it the ways I sort of laid out for you. They paid themselves salaries, bigger salaries. They paid themselves rent. They bought the buildings and rented it to the company. They paid themselves interest, loaned money, and got the interest back. All those are tax deductible on the corporate side. All of them will be taxed on the individual side. Again, I'm not suggesting anything that's illegal or improper. But people will respond to incentives. That's what will happen. So, sort of sum it all up, and then we can talk about whatever you might want to talk about. Okay. Challenges in tax reform. Do remember that economic incidents and tax incidents are the same thing. People pay taxes ultimately. Which people is a question, but people pay taxes. Taxpayers do respond to incentives. You talked, I know, yesterday about this differential behavioral effect that might occur. Tax is a silent partner in all economic transactions. I teach in a business school, I teach in our executive programs. They're very well aware that the tax, this is gender neutral, the tax man is a party to every single transaction they engage in, directly or indirectly. And this issue of simplicity, I really encourage you, if there's any way to pursue it, because what we've got now is so difficult for even the average person to get their arms around. And we live in interesting times. I would commend to you, for those of you that are particularly interested in tax policy kinds of issues, Gene Sterling has a very good book, sort of looking back over the past, talking about contemporary U.S. tax policy that he's been around, in and around. Many of you know him or have met him through the years. This is really a wonderful book that he's put together looking at tax policy. There's a history of taxation, sort of fun to look at. If you want the business perspective on tax planning, the best book that I know of is this book, Scholes, Wolfson, Erickson, Adel, and Shevlin. It's a book called Taxes in Business Strategy, and it gives you some of the building blocks that business people in large corporations are using. And then, of course, all the websites. So, I'll open it up for questions, or thank you very much for attending the Church 6.
Thank you all for coming, and if you would mind filling out the survey before you leave, that would be great. And please raise your hand so I can give you the mic if you would like to ask a question.
Be careful of that. Do you know the percentage of taxpayers that pay over $250,000 a year that are small business owners?
Lots of them.
I mean, I know the majority of them would be, I would think, so.
They are. That whole bracket is made up of the business people primarily. And also, one other thing that you should be aware of is that $250,000 is kind of a funny cut. I worked for Statistics of Income for a lot of years, and they had a $250,000 cut back in the 50s. It's just kind of an artifact of the way the statistics get done. So actually, when you look at percentages, you can kind of see it coming through here. I've always been sort of surprised at the 250 because it's maintained its constancy across time, but I think it's driven by the way the statistics get presented. It's a typical cut point in statistics.
Do you know where I can find the number, like a good website or something?
Hang on to find that. Nice shot.
The complicated $193 billion per year spent on Americans for their tax.
Right.
What is the tax gap? Would that increase the amount of so-called tax gap if we make things clear, as opposed to saying that these are people who are cheating?
Yeah, the projected tax gap only comes from two sources. The truly unreported income non-doing fraud source, and the source that's I'm too confused to figure out what's going on in the source. I don't know the split between those two. And the last tax gap estimates, does anybody know what the last tax gap estimates were? It's hundreds of billions, but I don't know if it's 193 billion. It's more than that.
Are you including the cash accounting in the fraud side?
Yeah, the cash accounting would be fraud, right?
Okay.
If by definition it's fraud. If I receive income in cash and I don't report it, that's fraud. Yeah, that's. Are there any other questions?
Is there any evidence in your readings and all, when you're going over the fact that they did not index various deductions, didn't index various taxes, is there any evidence that you've ever run across that there wasn't a deliberate matter so that they could get more income, so that the predecessors of our bosses here would have more money to play with back in the 70s and 80s, and now that our bosses are in a situation of having more money to play with?
Well, as I recall, the tax code, when you really saw indexing start to come in was in the 70s. I mean, people actually talking about it. And they were talking about it because we were in inflation. We were in big inflationary times. So I think, a lot of these tax provisions that I sort of pointed to, the personal exemption, the AMT, the estate tax issue, all of those occurred in a sort of pre-massive inflationary environment, and I just don't think people thought about it. I honestly don't think it was purposeful. If they did it today, I would say it's purposeful, you know, because people are sort of aware of this inflationary effect. But I don't think back in the 50s and 40s, people were thinking about that so much. In 1916, when the estate tax came in. I just don't think it was as big an issue. I didn't see it, and you don't see it in the tax code coming through until really the 70s. You see some things being indexed.
Core inflation.
Yeah. Other questions? Well, thanks very much for all your attention. I know it's busy on the Hill. Is it about the right piece? I know everybody's sort of turn myself off.
Hey, Pete, do I press the stop? Press the stop button on here? Maybe you could.
Today, Chilean financial system is very sound and does not require, for now, a bailout, or your lending has been very frozen. The economy is being subject to some kind of a stimulus plan, which is what we put together. Some lessons may be applicable to the US and Europe, some may not. Let me finish with some broad implications for discussion. One is an additional one from Chile, which is, again, the importance of the macro. We tend to focus sometimes on one institutional detail, but the macro is extremely important. The macroeconomic management of the past decade or past in Chile has been stellar. So there is a huge reserve because of the stabilization fund that Chile has had with the proceeds of copper, and that's what's being used for the stimulus package. So there's no additional debt, and it's no breaking of the private pension plans like in the neighboring country Argentina, for instance. So it comes from a very solid basis, the stimulus plan that's being done. The way it balances the needs of social sector, increases also infrastructure needs, and so on is also important to watch. Chile also provides some lessons in terms of the stimulus plans, how to do effective infrastructure investment through concessions, and how to organize those concessions, like for roads, that is being done in a way that reduces the probability of recontracting, and therefore it reduces the probability of high cost and corruption. But that's not so much a topic of today. In terms of the stimulus plan, there will be more in that way. In terms of lessons for bailout, as I mentioned before, Sweden also provides lessons. They also need to be adapted because obviously another smaller country without the same complexity of the instruments that we see nowadays in the US. But just to impress upon the point that it's not obviously just Chile. We try to focus on Chile because generally that's not done. And let me finish by some general points for discussion in terms of the main overarching point of the forest, looking at the forest from an international perspective and not only at the very important each individual tree. It's very important to distinguish first between first and third order type of challenges and priorities. The whole debate on the bad bank, frankly, whether it has to be there or not there, it may become very secondary if none of the other fundamentals are addressed in terms of the macro. In terms of fundamentals, let me mention the 3 or 4 points. The first, which seems from an outsider perspective very much pending, is a very fast and transparent triage of banks. Writing down the losses to have accurate balance sheets, and then identifying very quickly the unviable banks. I know that it's easier said than done, but it seems to be also that that has to be a major political commitment. Identifying quickly at least a set of unviable banks and say for liquidation of those. And that comes both from Chile and Sweden as very clear lessons. So the transparency and speed in terms of having it and commitment political commitment included a bank reaction and recognized that some are just not viable and wanted to move very quickly with that. As long as there's a lot of uncertainty about that, the system remains frozen. Big, at the same time, once the reaction is done, big and fast has the viable banks with clear streams, obviously without undue breaks. One can recoup a lot of the loans and the implicit subsidies over time. Chile did that, and Sweden did that too. But temporarily, a risk shifting is important, and that was mentioned. But to proceed at this point when there's such a crisis without any dogma, and even for us in Chile, being totally free traders and ideologically driven towards the market, when a situation like that hits, having to have temporarily government ownership, if it has to be that that's a price to pay, as long as it's clearly stated that it is temporary and what the system is to recoup. And in that context, the forest being as important as it's tree having a sound macro footing. The macro footing in the short to medium term is not sound. Things can unravel, much of the financial crisis antecedents, in addition to the political mention, in addition to the technical, as macro rules as well. Both here in the US and the other regulatory reform is absolutely crucial. That is not being discussed too much here today or another discussion. We did touch upon political reforms, including the whole issue of political finance, political campaign financing, and very much related to the issue of capture that we did discuss and your influence in moving forward and restoring the trust and the confidence of the public is very important. And obviously transparency is very important. Minimizing the bailout cost, at least from the lessons of these other countries, perhaps ought not be a major, or certainly not the major objective. Sometimes it seems to me as an outside observer that it's an obsession with minimizing the bailout cost, and that can get into such trade-offs that the program basically does not have enough control. Yes, in Chile it was very costly, we paid 20%, but in terms of the medium and the long term, the gains were substantial.
Well, we do have plenty of time for questions if you guys have any. In fact, a reminder that if you can fill out those blue survey forms for us, that please help us to improve the quality of our courses. And if you do have a question, please raise your hand.
Hi, this question is for Professor Jones. Does the FDIC as presently constituted have any mechanism to hive off assets from a failed bank and resolve those separately? And let me give you, for instance, let's say a bank is in receivership. It's got an enormous book full of bad assets. The FDIC lines up a potential buyer, but that buyer says, well, look,